Generally, I think we're in kind of still looking at a risk-off environment for 2022. Gold is attractive. I think if you look at equity markets, I think some of the healthcare dividend stocks. I think some of the energy pipeline companies are interesting, right? Because they're less
Mhm.
tied to the price of the commodity and they pay very high yields and they're generally undervalued just because there's not a lot of large pools of capital that want to over own them. Gold has approximately 1.5% annual inflation rate, more or less, between 1 and 2% per year. And so I add that over time and it makes somewhat of a difference. But basically, I look at, the market cap of gold compared to some of the broad money supplies out there and kind of come to different ratio assessments. So I think the challenge right now is if you look at purchasing managers indices over time,
Mhm.
that kind of gives you like they tend to go in these roughly 3-year cycles where you have a period of acceleration or deceleration. And for people that are familiar with them, basically if it's over 50, things are expanding. If they're below 50, they're contracting, but it also gives you a rate of change signal. So if you go up to 60 and then you're coming back down to 55 and 50, you're still positive, but you're decelerating. And a lot of markets work in rate of change terms. And so if you look at the PMI over time, it's this sine wave with occasional spikes or up or down based on big crises like 2008 or 2020. But for the most part, it goes through the sine wave. And so, for example, in the 2017 period hiking cycle, that was a rising PMI environment. You also had upcoming tax cuts that were about to happen, so the market was rather bullish. You had equities do well. That was a big Bitcoin bull run, for example. Generally, any sort of risk asset did very well. Um, in late 2021 and early 2022, we see PMIs are rolling over, right? So that's generally a more challenging environment. It's kind of similar to late 2018 and into 2019. Generally, I think we're in kind of still looking at a risk-off environment for 2022, at least until I see some sort of catalyst that would change that. And so I think generally gold is attractive. I think if you look at equity markets, I think some of the healthcare dividend stocks. I think some of the energy pipeline companies are interesting, right? Because they're less
Mhm.
tied to the price of the commodity and they pay very high yields and they're generally undervalued just because there's not a lot of large pools of capital that want to over own them, partially due to ESG mandates. Um, and so I think those are some areas that are interesting now. But looking at longer term, I think energy producers, I think commodity producers, I just have a little bit of a caution here in 2022 because I see us kind of going through somewhat of a kind of a longer term risk off period. And I don't know if that could mean that stocks chop around sideways for a year. Could mean, some people calling for a crash. I mean, we've seen some early volatility this year. I don't have a
Mhm.
specific view because it partially depends on estimating what policymakers are going to do in response to things. But generally, until I see catalysts that suggest otherwise, I have a somewhat defensive outlook. I want to, buy something that's going to be higher 3 years from now, 5 years from now. And so for investors that want to look through volatility events, I think it comes down to, you know, position sizing around the risk of permanent capital loss more so than just volatility. So a lot of fund
Mhm.
managers think in terms of volatility, but if you're not leveraged and if you have a long time preference, I think that it's more about managing risk around the risk of permanent capital loss, which is different. It's related. I mean, things that have a higher risk of permanent capital loss usually have higher volatility, but it's not a one-to-one correlation. If I
Mhm.
make a bigger move or a more specific thing, I do like to see some degree of price confirmation. So I use some very basic technical analysis to look for, things that you can't guarantee something's a bottom or a top. But I don't want to buy a falling knife, for example. So if there's something that I think is fundamentally attractive, I'll look for signs that it's also stabilizing and turning up in price. I'll let other people try to catch the falling knife, and then when it starts to turn up, and I don't want to just buy a line on a chart. So I never just do technical analysis. I don't want to, I want to
Mhm.
know what I own. So everything for me is rooted in long-term fundamental analysis. But it is nice to start seeing that price confirmation. So sometimes I look at things, just normally priced in dollars, but then I also look at some ratios, like what is the S&P 500 doing relative to gold? Is that momentum rolling over? Is it rolling up? And so I look at combinations of price charts and ratio charts that you know they don't guarantee that something's going to work out, but they help provide a catalyst and they help do a little bit of risk management for momentum. Yeah, but as of this moment, we have been seeing over the past couple of weeks a rolling over period. The most notable one since the start of the, kind of going into the pandemic and the whole kind of, 2019 period. Um, you can get fake outs on these ratios, right? So, I mean, we just had a big capitulation in the markets. I wouldn't be surprised to see risk assets bounce somewhat. So it's something I continue to monitor. But combined with the rolling over PMIs and generally the risk off environment, kind of fiscal stimulus pulling back, I do think that overall makes sense to see some of these risk assets rolling over relative to gold. And it's still early stage. I mean, gold basically has been flat while the other ones have been, down. We're also seeing some interesting kind of U.S. to foreign equity rotations that I'm not sure they have legs yet or not, but it's something I'm watching. As I mentioned before, investors are kind of at record low allocations to emerging markets. And so we're starting to see kind of basically we had this kind of early kind of mini crash here in January in U.S. stocks, but emerging markets held up much better, which is actually similar to what happened in late 2018. That was kind of a U.S. focused market decline, and so we're starting to see similar action this time. That time it was kind of a fake out; it didn't really have legs to it. I think this one has a better shot of having, kind of a longer regime shift associated with it. But it's something I'm watching for follow through. Basically, the valuations are more attractive. It's under owned, all those foreign equities. But of course, you have risks and currency risks when you get into that environment as well. The world demographics are certainly a lot weaker in this period than they were in the 70s or the 2000s. So in the 70s, you had massive American demographics. That was kind of the peak. Baby boomers were buying homes. And then in the 2000s, you had the rise of emerging markets in China. Now we're seeing kind of Chinese population sort of peak out, especially the working age population. India is not really kind of big enough to kind of fully take that baton yet, but I think that's kind of a market to watch. Same thing for parts of Africa. And so I think that if we get that weaker dollar environment, and especially given the weak capex in the energy markets, I do expect a pretty big bull move. But I think that the major headwind is demographics. So I guess I would err on the side of maybe not quite as big as what some people are expecting, but still rather big. But there's a huge range for that where that could turn out because you're measuring it in dollars and dollars have no bottom, right? So depending on things that happen, there's no limit to how high something can go priced in dollars. So I think ratio charts, maybe you'll have, if you look at say the copper to gold ratio, you had a really big spike in the 2000s, and that was kind of the rise of Chinese construction. I wouldn't necessarily expect a big spike like that again. So I think that some of those ratio charts maybe be a little bit more muted, but overall it kind of depends on if the bottom really falls out of some of these currencies or if you just go through a more kind of normal cycle.